Doing all right? Homework number 2 is due tonight, so make sure you get that in. Today we'll finish up chapter 3. We got to that first problem in the second set of in-class problems, so we'll flip through the rest of those problems. There's only a couple. And then there's one kind of at the end that I'd like to show you for chapter 3. And then we'll do chapter 4. We'll go through the first half of the slides today, and then do some problems on that. So income statement, kind of our goal today. Any questions before we get going? Yeah.
Yeah. How do you make T charts in Microsoft Word?
In Word?
Yeah.
What I would do is I would make them in Excel and then copy and paste them into Word. That's a little easier than using the Word. Word has a process for creating tables, but it's pretty easier to do it in Excel and then copy and paste in. Do you guys know how to do Excel? Kind of do the lines at the bottom, or is that okay? I think that's easier to do it in Excel and then copy it and paste it into Word. Is that okay?
Yeah.
Okay, all right. That would be my suggestion. There's a way to do it in Word, but it's just easier. Anything else? All right, let's get going then. All right, so we left off with this one here, exercise 11. We went through this whole process of preparing all these pieces, and then that was online as a Excel file, the solution to that. Then there's a few more problems, a few more questions here that we can go through. So if you remember chapter 3, we talked about the accounting information system and the process that we follow to take a transaction and turn it into a financial statement. So here's a question. Second half, Big Mouth Frog. They have revenues of $330,000, expenses of $200,000, and dividends of $45,000. So this is about a closing entry. Remember, with closing entries, we take revenues, close them to the income summary account. We take expenses, close them to income summary. And then we take that income summary account and close it out to retained earnings. And then lastly, we close our dividends to retained earnings. So in this case, when income summary is closed to retained earnings, what's the amount of the debit or credit to retained earnings? Any idea here? So, okay.
It's a credit of $130,000.
130,000. How did you get that?
I subtracted the expenses from the revenues,
Right.
and then because we're closing retained earnings, then the income summary will be debit and return earnings.
That's right. Yep. So that's what we're going to do. We're going to take all these revenues and expenses. We're going to move them from those income statement accounts, revenues and expenses, into our income summary account. Our income summary account is then going to be pushed into retained earnings. That's the process we take to move net income into retained earnings. So retained earnings should increase by the amount of net income. That means retained earnings has to have a credit of $130,000, the amount of net income. All right, so which type of account is always debited during the closing process? Dividends, expense, revenue, retained earnings, or something else. So always debited. So in this case, what do we need to debit to close? To make the zero. Revenue, that's right. Yeah, because revenue has a credit balance, right? We got to make that zero, so we got to debit it. So, which of the following statements best describe the purpose of closing entries? What are we trying to do with them? Facilitate posting and take a trial balance. Determine the amount of net income or net loss. Reduce the balances to zero so that we can use them to accumulate revenues and expenses for the next period, or complete the record of various transactions that were started in a prior period. Yes, C. Yeah, C. That's right. That's the exact reason we're doing it. Remember, like the closing process, we're trying to get rid of those temporary accounts, make them zero, so that we can start over with them the next And then closing entries, you guys have, we went through a big example. I'm not going to have you guys do this one in class. You can do that at home. Again, we're just going to take all of these. You guys did this in your homework too, so you've seen this a bunch of times. Take all of these revenue accounts, and we're going to close them out to 0. And then we're going to transfer that to income summary. We're going to transfer the income summary to retained earnings. And then, let's see, was there any dividends? There's no dividends in that. So that's a really easy problem. All right. So this last one is the one I wanted to show you. Do you guys have any idea? So this, I don't know if you looked at this at all. You know, your weekends, just looking through the slides again. No, nobody? Okay. So this is an E318 cash to accrual basis. I think this is kind of an interesting one. I don't think this was even in your homework, but it's something to think about because when we get to the cash flow statement, we're going to have to do something like this. So in this case, we have this Jill Accardo. She has a clinic that keeps records on cash basis. And during 2014, she collects $142,000 from her patients and pays $55,470 in expenses. At January 1st and December 31st, she had these balances. And what it asks you to do is to prepare a schedule that converts the excess amount of cash collected over cash dispersed, so their cash basis income, convert that to accrual basis income, the way that we would try to record it on the financial statements. So what we're going to try to do with this is take this cash basis income and adjust for each of these. So if you remember, these are adjusting entries, right? We have adjusting entries involved with accounts receivable, unearned service revenue, accrued expenses, and prepaid expenses. It's how we kind of have accrual accounting with these adjusting entries. So we're going to look at the change in the values that are these accounts that are associated with adjusting entries associated with accrual accounting, and we're going to try to convert cash basis net income into accrual basis net income. So just so you guys don't have to calculate things, I'm going to show you how to kind of do this, where I'll ask you. You guys can give me your opinion about what you think you should do. So the first thing to do in a problem like this is to come up with what's the excess of cash collected over cash dispersed. They give us these numbers. The excess is $87,130, and that's what we're going to start with. And then we're going to look at the differences in accounts receivable, unearned service revenue, accrued expenses, and prepaid expenses, and try to decide what to do with these to convert this into an accrual basis number. So do you have any idea what you would do with an increase in accounts receivable? What does that sort of represent?
Turning less payments into cash.
Turning less payments into cash. It would be,
Like
yeah, right.
Your collection period is longer.
Those are good things, but with respect to revenue. So revenue,
Your revenue's going up.
right, you have revenue, but you don't have cash. So in that case, what do you think you would do with it? Convert from cash to net income. You'd want to add it, right? It's revenues that don't have cash associated with it. So this number doesn't have those revenues in it because it's just cash related. Does that make sense? So I'll kind of write it up here. So the journal entry would be so this journal entry, so 6677, would represent an increase to net income that doesn't have any cash associated. Does that make sense? All right. So that's the first one. Hopefully I can do this the other way. From down from the top. Oh, no. Okay. Well, we're going to look at it. We'll just go through it. So this is how we do it. So that's, the increase in AR is going to be added. So next, if you have unearned revenue, you think about it the same way. This is another one of these adjusting entries. What does the journal entry with unearned revenue look like? So remember, unearned revenue is we have a prepaid or a deferred revenue is another way. This is a situation where we have cash, and we're going to have to earn that revenue. So the most usual example is like subscription revenue. So I had cash, and I'm a newspaper. I have to provide newspapers to somebody. They paid me for their subscription. Beforehand, I have to provide those newspapers throughout the year, and I haven't earned it, but I got the cash up front. We call that unearned revenue. All right, so in this case, this is the usual setup for it. This is cash that I spent on something that, revenue that I didn't earn. So in this case, I'm going to subtract that amount. So I didn't actually earn this revenue, but I spent cash on it. Does that make sense? So I would subtract that amount from the cash basis net income. Cash for revenue that I didn't actually earn. All right, so that's that one. I know it gets a little tricky but the journal entries sometimes make sense, right? It kind of helps a little bit. All right. So I got this cash, but I didn't actually earn the revenue. All right, so the next one is a decrease in accrued expenses. So I have a decrease in accrued expenses. So what happens when we have a decrease in accrued expenses?
You debit notes payable and then credit cash.
So that would be notes payable. Right, that's right. Yep. Or accounts payable. It doesn't matter. Yep. So in that case, so you're right. What's happening here? We have cash being paid for expenses that we haven't incurred, right? So since cash went down and the expenses didn't actually occur, we would add that decrease in accrued expenses. And then finally, an increase in prepaid expenses. So what happens when we have this journal entry? Like so prepaid, we would have prepaid rent. And cash. So again, we have an increase in an asset. We're spending cash on something, but we didn't actually have revenue associated with it, or expense associated with it. Expense associated with it, right? So this is the expense, prepaid expense. So you're spending cash on an expense that we haven't incurred. Does this kind of make sense? We'll find some rules to follow for this when we get to the cash flow chapter. That'll make it a little easier, but I just think this is a good problem. I'll put this on right space to the solution, but that's how you get from cash accounting to accrual basis accounting. We think about all these adjusting entries that we make and how they might affect cash or not affect cash, but affect accrual basis net income. All right, any other questions about chapter 3? Everything was okay there? Yeah? All right. 100%. That's what I'm expecting. All right, so chapter 4 is the income statement. And one thing, I had a couple questions about, I don't know some of these accounts maybe. When we get to, through these next 2 chapters, you're going to see these accounts again and again, and hopefully that helps you kind of remember what they are, assets, liabilities, equity, net income, or part of income, where they actually sit, so you can do debits and credits and what you're doing. So, anyway, but chapter 4, I'll quickly go through this too, so we can get, you guys had the videos, but I know it was good to see it again. One of the things I did when I was going through this today, Because a lot of these examples are so old. I updated some of the examples, so you guys get fresh examples. Because you came to class today, it's like a bonus, right? This is great. Great Tuesday. All right. So net income. So income statement, right? I think income statement is the statement that is investors look at the most because they want to know the performance of a company and they want to be able to compare it to their expectations of how the company was going to do. And a lot of times, if you're trying to forecast the value, trying to predict the value, kind of come up with a valuation for a company, you're going to use net income as a basis for that valuation. So recurring net income is sort of one of the ways that you do it, the dividend discount model, right? But you can modify that so that it's based on earnings. Anyway, that's how investors come up with fundamental values a lot of the time. All right, so what is the usefulness of the income statement? Like I said, really great for predicting future performance, evaluating past performance. If you had some model where you tried to predict what net income was going to be, you can evaluate that with this statement, what performance you thought was going, how you thought performance was going to turn out. You can evaluate it with this statement. And then it helps assess the risk or uncertainty of achieving future cash flows. So you got a lot of information about the sources of their business, of their cash flows, right? Income is where they're going to generate cash. All right, so limitations. You're going to hear this one on all of them. You can't measure a lot of things in financial statements, and so those things aren't going to be in the income statement, right? So, things like intangible assets a lot of times. So I think right now, actually, you see the markets are kind of tanking right now. A lot of this fluctuation in the markets right now is because people, the tech companies are valued so highly, and sometimes people are having sort of second thoughts about whether or not those valuations are appropriate. And a lot of times, a tech company its valuation is based on these intangible assets, like I said. And we'll talk about those, like patents, ideas, things like that. How much is an idea worth to you? Well, a lot of times that's not going to show up in the financial statements. And a lot of times that's really important, especially for a tech company. Right? So that's a big problem. It's a big thing that they're discussing at the FASB right now. All right, I'm talking too much. You guys already saw all of this. Income involves judgment too. So we'll talk about judgment, and judgment extends to which methods are employed. What is management trying to do when they're painting the picture of their financial statements? So that's a big thing, quality of earnings. Companies have incentives to manage income because, particularly to meet or beat Wall Street expectations, because sometimes managers, CEOs are paid based on achieving these objectives, right? And stock prices, right? They move based on whether or not you hit a target set by analysts. And if you hit that target, the stock price goes up, and the CEO owns $5 million worth of stock in the company. That's going to be really great for him. So a lot of incentives to manage earnings by the people who are producing the financial statements. So that's something to think about. All right, so one of the big things in this chapter is differentiating between this single-step basic income statement, where we just have revenues listed, expenses listed, revenues minus expenses equals net income, and differentiating between this and the multi-step income statement. So this is the single-step. You guys have all seen a single-step income statement, right? Have you guys all seen the multi-step income statement? Yeah, you guys have? Okay. So that's one of the big things we're going to talk about more here. Some of these items that show up, income tax expense, also usually is down here at the bottom. We have to calculate that based on some assumed income tax rate, effective income tax rate. With the multi-step income statement, I need to know the steps involved. So You guys may all be fine with this, but so you might have sales minus cost of goods sold equals gross profit minus these operating expenses, which generally are selling, general, and administrative expenses. That's G and A. Selling, general, and administrative is usually what we subtract off of there. And that should get you to operating profit all right, income from operations. And then we can subtract off plus or minus other gains and losses. So these are non-operating items, non-operating gains and losses. I could say other or non-operating, right? And that'll get you to income before taxes. And subtract off income tax. Then you get to net income. So I need you guys, make sure you can do this, and then when we introduce discontinued operations at the end of this chapter, this changes, the bottom half changes, right? Discontinued operations, the FASB allows you to report them net of tax, meaning below the tax line. So they're reported down here. And generally what we think about here is that the most important stuff, the most recurring stuff is going to be up here in the operating section. The non-operating stuff is not related to the core line of business. So it's down here. So if you think about an income statement, as an analyst or an investor, the top stuff is the most important. It's related to the core line of business. Gross profit is right, so how much they make on each item they sell. And then operating profit is the next most important. And then when you get down to the bottom, there's some other stuff that's could be transitory, meaning it could be one-time events that's just kind of flowing through it. So this is like the benefit of using a multi-step income statement. But the trade-off is there's a lot of subjectivity in where these things go. And so I'll show you with this example. So you have operating section, non-operating section, and then income tax expense down here. So that's the basic setup, right? And then these are regular items, unusual gains and losses, discontinued operations, and non-controlling interest. Unusual gains and losses, unusual things. Some of these other gains and losses could be unusual or infrequent in nature. And so that's kind of where these go. They go to this other, usually it goes below operating profit. If you have stuff happen in your ordinary line of business that's unusual or infrequent, the FASB allows you to put it down here in this other gains and losses category. All right, so that's kind of what's going on here. A lot of times what happens, restructuring charges are very common. So one thing to note here is these are still pre-tax amounts that we're going to report. They're above the income tax line. It's pre-tax amounts. The FASB does not allow you to use net of tax treatment for these. But here's sort of the definitions. But if you look at Disney, so I think I've had like really old examples unless I put Disney in here. Disney's a great example because they recently had tons of restructuring charges because of COVID. So last year, if you look at their restructuring impairment charge, I don't know if you can read that, but they had 10% of revenues is how much they charged to restructuring. Part of the reason, a big reason why they missed their net income number, or they got a loss, right? A net loss of $2 billion. Because they had these restructuring charges, basically they're laying off workers. You can tell by looking to their notes, so you can see the two things. They recognized an impairment charge at $0.6 billion. That's the main 2021 impairment charge, primarily related to plant closure abandoned studio, and a substantial number of our Disney branded retail stores, as well as some severance at our parks and experiences businesses. So a lot of that's related to COVID, right? They had to close down a bunch of stuff because you can't have in-person, Disney World adventures, if COVID's happening. So they closed a bunch of stuff. So that's kind of, you can follow things through here. I'll put this online too to update, so you guys have that. They also acquired 21st Century Fox, which I think is kind of interesting. It's a portion of, I think they got like the movie business out of Fox. I think it was called 20th Century Fox, but now you got to change the name now because it's not the 20th century anymore. But yeah. So, and then part of that acquisition was to do some restructuring, fire people, and reorganize. And then the other option is eBay. So eBay doesn't report any restructuring charges on their income statement, but when you go to their notes, they talk about restructuring, and they actually hide their restructuring in selling general administrative expenses. So they didn't actually follow the guidance in GAAP that allowed them to put it down here in other gains and losses. They actually had it up here in their operating profit. So, one thing to pay attention to is, looking at the notes. So if you're an analyst, if you're trying to come up with an expectation of future profits, and you're using just this information in the income statement, it might not be a great idea. You need to look at the footnotes because things could be hidden in here, hidden in these line items. Like restructuring costs probably are not recurring, but for eBay, it's in part of that line item, that SG&A, which is right up here in their operating profit, and would be considered recurring probably, right? So, all right. I know I'm talking a lot this time, but I like these new examples. They're better. Okay. Unusual gains and losses. Discontinued operations is the other thing. We're not really going to get to. I'll get through these unusual items, and then we'll do problems. Discontinued operations are when you eliminate operations and the cash flow component of an item that's can be clearly distinguished operationally and for financial reporting purposes from the rest of the entity. So you have to not have any significant continuing involvement with discontinued operations. These are net of tax, meaning that they're reported down here below the income tax line. So we're going to change the income statement to accommodate discontinued operations. I think I go through this one. Did I go through this in the slide? Yeah, I think I did. So, the point is you have to be able to distinguish the cash flow of the discontinued operation from the rest of the company. And in this case, you have two examples. One where they sort of stay in the business, but they get rid of a brand. That's not really a discontinued operation. Discontinued operation means you have to completely get rid of that. You have to be able to distinguish that portion of the business that you get rid of. So that's what that is. So when you do this, there's two portions of it. There is operations portion and a disposal portion. So if I sell part of the business, and that business has been running for half the year, there's the operations of that business. That's all going to be relegated to discontinued operations. And then there's going to be a disposal, the sale, right? You have a gain or loss on the sale of that company. That's going to be part of discontinued operations. All of that gets reported down here, net of tax. So what happens is, rather than all this stuff, now we're going to have income from continuing operations before tax and income tax. And then income from continuing operations. Which is right here. And then, discontinued operations. Net of tax. This is net of tax disclosed, right? And then, so that's probably two components, operations and the disposal. And then we have net income. So again, this is like we have net of tax disclosure, net of tax treatment here. It gets allowed to be reported below the income tax line. It's another example, right? So now, change from net income to income from continuing operations. We have this discontinued operation part, and then net income. So here's eBay. eBay had a big discontinued operation this last year. Again, so what they did, well, we can figure it out. Right? You can see income from discontinued operations, income from continuing operations. And again, this is net of tax, right? Net of income taxes. The income taxes are up here. Continuing operations before income taxes, income tax provision. Continuing operations, discontinued operations, and then net income. So a lot of discontinued operations, actually the discontinued operations were a bigger portion of their net income in 2020 than their continuing operations. You can see when you go to their notes what that's about. I mean, they had two things that they are selling, two portions of the business that they're selling that they're not going to participate in anymore. Part of it is StubHub. I guess they sold StubHub to a company called Viagogo. In 2019, they entered into the agreement, and they completed the sale in 2020. So that's a big portion of it. They got $4.1 billion in proceeds for a pre-tax gain of $3.9 billion on StubHub. Why do you think that gain is so big? Anybody have an idea? They spent $4.1 billion, and they got a gain of 3.9. What is Viagogo buying? Tickets? I don't think they're buying. They don't get the tickets. So StubHub doesn't own the tickets. They just are like the coordinator. So what did Viagogo buy for $4.1 billion? If they were allowed to book a $3.9 billion gain, which means they only StubHub was on the books for $0.2 billion, $200 million, but they sold it for $4.1 billion. So why do you think you would sell it? Why do you think that would happen?
Market value is way different than the book value.
Exactly right. Yeah. And the reason is StubHub, right? It's got intangible assets. It's a website. It's got customer lists. People know about StubHub, the brand. All these things are not valued in the income on the balance sheet. Internally created intangible assets, brands, things like that. You can't really value them until you sell the asset. You don't really know what the StubHub brand is worth, what their customers are worth, until you try to sell it. And when somebody's willing to pay something for it, then you have an idea about what it's worth. So StubHub, right? This is a huge asset. This brand, this website. Huge asset that really didn't fit on the balance sheet. So it's a big thing to think about, especially with tech companies, right? As a tech company, they're facilitating ticket sales. So yeah, anyway, it kind of reinforces that previous point. So StubHub, that's a big portion of its discontinued operations. They made a ton of money selling it on the balance sheet, but obviously those assets, someone was valuing them. And then classifieds, I guess, StubHub, I guess eBay used to have a classifieds thing. It's kind of like Craigslist, where people could get together and buy and sell stuff. Anyway, they sold that too. But this is how it breaks it down here. So you can kind of see what happened with discontinued operations. All right, so just I'll do this quick review question, and then we can go on to do some problems. Oops. I always do this. I screwed it up. So discontinued operations should be reported separately in both the single step or multi-step. Yeah, okay. Not a single step or multi-step only. Neither single step or multi-step. We always are going to report discontinued operations separately and net of tax at the very bottom when we have them. Okay, it's not something where it would matter if we had a single step or multi-step income statement. All right. Ruin the question. All right. Should we do non-controlling interest? Yeah, what the hell? All right, this will go fast. So like the last one, I just want you to be aware of this because it's going to come up several times. You have a big merger, company A buys company B. I think, at some point, eBay owns Skype. eBay buys Skype. Microsoft bought them subsequently. Microsoft buys Skype. They buy like 50% of Skype, which is like the controlling interest of Skype. So then they can basically control Skype. And so they don't really need to own more than 50% because once you control a company, you can, kind of tell what to do, whatever. That happens a lot in corporate America. Company A buys company B, but they don't buy 100% of company B. They buy 50%, so they can control. When that happens, the remaining 49%, or 51%, so you control, remaining 49% is a non-controlling interest. So there are other shareholders who own 49% of that company, and they're entitled to 49% of that subsidiaries, that company's net income, even though company A and company B are going to be considered one consolidated company under GAAP. So that's what a non-controlling interest is. Does that make sense? Like you have two companies, they merge. You think about them as one company, but some shareholders might own part of company B, and they deserve part of company B's profits. They are entitled to it, even though you look at it like a consolidated company. All right. That's what a non-controlling interest is. And with non-controlling interest, when you have net income, part of that net income is allocated to non-controlling interest or minority interest. It shows up on the bottom of the income statement. Just so you know, that's there. That's important. When you're trying to come up with how much to value a company at, you need to allocate a portion of that income to these other shareholders who aren't represented by the stock price of Microsoft in the example I gave. All right. So that's our irregular items. In the next class, we'll talk about these earnings per share, changes, errors, and comprehensive income. But I think that's pretty good for today. So what we can do is we can go through some more problems here. Is this stuff okay? Do you like the net income statement? You guys seen most of this stuff? Yeah. This whole first, 3 or 4 chapters, first exam, a lot of it is going to be, you're going to have seen it before in your intro class. We'll go into more detail when we get to the second and third exams. But recap, a lot of recap here. It's important to know. Make sure you guys know this stuff really well. All right, the income statement provides investors and creditors with information to predict all of the following, except the amount of future cash flows, sources of future cash flows, timing of future cash flows, uncertainty of future cash flows. Which one do you think would be? Yeah. A. Amount of future cash flows. Well, that's kind of what you want to do. I think that you would want to predict it. But you should have some information to be able to predict future cash flows. Anybody else want to guess? Yeah. Well, so that's also another thing where you might have some information about the timing. All the information you kind of can have, right? Because you have, income, accounts receivable. You can assume that's going to be collected within 90 days. So I think the timing should be able to time some of that uncertainty. Some uncertainty information. Really, the sources you have no idea about. So, this is a tough question because you could say none of that really is pretty hard to get a lot of that information. But you definitely don't have any information about the sources of future debt. So does it come from operations or from borrowing money? None of that's in especially the information about whether you're going to borrow money or issue shares to raise capital, raise money. That stuff's not in the income statement. So, that's kind of a tough question, but sources, I think, the point of this is that the statement of cash flows gives you information about the sources of future cash flows. All right, for Mortensen Company, the following information is available: cost of goods sold, dividend revenue, income tax expense, operating expense, and sales revenue. In a single-step income statement, what's gross profit? Yeah.
A.
Yeah, it doesn't. It shouldn't be reported, right? Yeah, that's right. So a single step, it doesn't get reported. But in a multi-step, how much is gross profit? Would it be reported? Yeah, right. Right there. Yeah.
CU 210.
210. That's right. Yeah. Sales revenue 600 minus 390 in cost of goods sold will give you your gross profit. All right, we did that one, and I blew it again. All right. The following information was extracted from the 2020 financial statements of Max Company. Super company, Max Company. Income from continuing operations before income tax, selling SG&A. Income from continuing operations, gross profit. What amount reported for other? What? That is terrible grammar. What is the amount reported for other expenses and losses? The amount reported for other expenses and losses is. So other expenses and losses. I guess that's this other gains and losses kind of thing. The other category. Yeah,
C.
as you can see, yeah.
Just gross profit minus selling administrative and then subtract 705.
Right. Gross profit minus selling administrative is going to get you the operating profit. And the difference between income from continuing operations before tax and operating profit is going to be that number. Everybody get that? Good. Let me go through here. So we had gross profit of 1,350. We have SG&A of 480. So we can get operating profit of 9. How much is this? 8, 5, 15, 87,000. 1 million. Yeah. 870,000. And then income from continuing operations. Continuing operations before income tax is 705. So the missing piece is gotta be 165. Is that right? Okay. Cool. So yeah, that's great. Manipulating the income statement. Another one, Lantos Company had a 20% income tax rates. Given the following pre-tax amounts, what would the income tax expense reported on the face? What would be the income tax expense reported on the face of the income statement? So if you remember, we want to get to income from income before taxes. And there's the discontinued operations here. So income from continuing operations before taxes. Then we're going to multiply it by the income tax rate to get whatever income tax expense should be. Extra space here. My spreadsheet. Income tax. All right. Any guesses here? Tricky question about the income statement. Got $1 million in sales. Somebody would take a shot or? Yeah.
C, 36,000?
I think it's 54. You ready to get 54? So we'll try to go through it. Sales is $1 million. Cost of goods sold is $600,000. So $400,000 was our gross profit. Selling general administrative expenses are going to include salaries and wages expense, depreciation expense. So $80,000 and 110. Utilities expense of 10, and interest expense of 20. So, I guess I can try to, or not interest expense, everything but interest expense. So let's see, salaries and wage expense.
I think it's 200,000.
Just total,
I think so, yeah.
all those together. I can just do it in Excel. 80,000, yeah, 200,000. Yep. So 200,000. So operating profit is going to be 200,000. And then our interest expense is $20,000. That would be an other gain or loss, usually interest expense. Company's main line of business, unless they're a bank, is usually not to make loans or take loans, interest expense, interest revenue. So that gets us down to, or dividend revenue also. Oh, we got dividend revenue here, right? Yeah. 110.90. All right, so now we're at income from continuing operations before tax, 180,000 times 20%. That should equal 54. 18 times 2. Is there? That's not right. So this has got to be.
We didn't include the dividend revenue anywhere.
All right, that's the problem. Okay. Yeah, dividend revenue could either be an other gain or loss, or it could be an SG&A. Probably another gain or loss. So it's going to be the 90 minus the 20. Good catch. All right, so then we're in better shape. 70,000. 270. That's how we get it. Good. Awesome. 54 grand. So this is $270,000 times 20% to give us our income tax. Is that all right?
Can we add dividend revenue?
Yeah, that's revenue. Yep. So it needs to be positive. So I would probably put it in other gains and losses unless investing is part of their main line of business. It probably isn't. Doesn't go there. Yeah.
Why would you not include utilities before computing the tax?
Utilities expense, right? So that is part of SG&A. So I should break out SG&A. So SG&A would be salaries and wages. Depreciation expense. And I also include utilities expense. So all those three should give you $200,000 in expense, which we just summarized in SG&A is $200,000. Is that right? Okay. So then we get down here, other gains and losses, our investing gains, investing dividend revenue, and our interest expense offset, right? Those aren't really part of our main line of business. And that gets us to 270 and 54,000. The other kind of question you can ask here is what would we do with our discontinued operations loss? So our loss, if that's a pre-tax loss, $100,000, what would we do with it? You have to adjust it for taxes. So you get 54,000 here. So our income from continuing operations, we 270,000 minus 54,000, 216,000. And then you could do our discontinued operations. Our discontinued operation loss was $100,000. They don't tell you that tell you if that's pre-tax or post-tax. If you assume it's pre-tax, then what do we have to subtract off? $20,000, right? So then it has to be $80,000 here. It's usually got two parts to it, but I guess this is just got one. And so you can get to 136,000 for net income. Does that make sense? So we just go through the whole thing. Good? All right. We have another opportunity to do that kind of problem. Here's Hendrick Incorporated. We're going to put a multi-step income statement together here. guys, everybody get one? Everybody have it? Okay. The extras? You guys feel okay about this one? get a chance to go through it, or you still working? Seems like trouble. All right. So, you guys okay with this? Okay. So we're going to start with net sales, right? And then subtract off cost of goods sold. We have interest expense. That's sort of an other, right? Selling expense and administrative expenses. Those are other or operating. Those operating expenses. Those are operating expenses. So those are going to go up here. And then, so that's kind of where we're at. We have sales, cost of goods sold, operating expenses. We should be able to calculate operating profit, the other gains and losses. That's your interest expense. That should get us to income from continuing operations. Before tax, our income tax is going to be 20% of that. And then we're going to have income from continuing operations. And we have this discontinued operations loss of $20,000. We're going to adjust that for tax, and then we're going to get to net income. So you should be able to get to something like this. So $105,000 of gross margin, 270 minus 165, you get 105,000. I'll leave this up here for you guys. And then selling expenses are 15, administrative were 35, so you get $50,000 in operating expenses. So 55,000 is your income from operations. Interest expense is 3,000. Income before tax is going to be 52,000. You can call it income before income tax, or you can call it income from continuing operations before tax. I think you can do either, right? So income tax is 10,400. And then you get income from the operations, and then finally, our tax-adjusted discontinued operations number that we subtract off to get net income. Did anybody get earnings per share? Did anybody go to do the second half of this? We haven't even talked about that today, but we'll talk about that on Thursday, calculating earnings per share. But every time you put together an income statement, you need to show the amounts on a per share basis. Show income from continuing operations, discontinued operations, and net income on a per share basis. So that's what, if you wanted to really do a complete income statement, you'd have that as well. So, one thing to note, I think people get confused sometimes between income from continuing operations and operating income from operations, income from continuing operations. I think sometimes people get confused between those two. Don't screw those up. If you have a discontinued operations, you're going to have income from continuing operations, but that's going to be like your net income number without discontinued operations. Income from operations or operating profit is going to be the number up here from your the top portion. It doesn't include these non-operating items. Does that make sense? There's these two line items sound similar, so make sure you keep an eye out when you got like a multiple choice question, question where someone might ask you, what was income from operations? You shouldn't think about that as this number down here. You should think of it as this number up here. All right. They sound similar. That's why. Make sure you can pick them out. All right, this is the last thing we'll do for the last 10 minutes. Indicate the major section or subsection of the multi-step income statement where each of these items are going to appear. So we'll go through each of them. I think one of these a few of these you probably haven't seen before, so it'll be good to go through them and kind of, I don't know, maybe you haven't seen them, maybe you've seen everything. We'll see. All right, so advertising, where would that fit here? Would that be, yeah, it's an operating, a selling expense, an operating expense. Yep. Depletion, how would depletion be handled? Well, so I don't know if you guys know, we haven't even talked about depletion. We'll talk about that a long time in the future. Depletion is, if you're a mining company or an oil company, you're going to have a mine or some kind of natural resource, and you're going to use it up, and you're going to sell that natural resource. So a mining company, I have a big oil, or an oil company, I have a big oil reserve. I use up that reserve, sell it. I deplete the reserve, the natural resource. So that's cost of goods sold, right? That's what I'm selling is the natural resource. So that's kind of how that works. Dividend revenue. How might we call it? Dividend revenue. Yeah.
Other gains and losses.
Right. Yep. Other revenue. Other gains and losses. Freight in. Right. So what is freight in? Do you guys know what freight in is? You see that in your intro. So what's included in? If I have inventory, what's included in the cost of my inventory? Right, transportation in, that's freight in, right? So how would that come through the income statement?
Either cost of goods sold or just cost of goods sold.
Yeah, the cost of goods sold. Stop right there, yeah. That's cost of goods sold, right? So, you would include it in the cost of the inventory, so when the inventory is sold, it would be sold. It would be part of cost of goods sold. So loss on disposal of a component of business, net of tax, completely separate component of business that we sold. What would that be? Yeah.
Discontinued.
Right, that's a discontinued operation. Income taxes, that's kind of a weird question. Income taxes. This is a terrible question. Income tax expense. Income taxes would be called income tax expense, a separate line item. It wouldn't be included up here. It's kind of funny, like I've had this question before. I think I show in my slides one situation where income tax expense is included in the single step income statement. It's included with all the other expenses. And there's no definitive guidance from the FASB about where income, on a single step income statement, about whether or not you need to have income tax expense in a separate category from all the other expenses in a single step. But in a multi-step, you always keep income tax expense as a separate item because you have to have income before taxes and income tax expense. But in the single step, right, that's kind of weird, right? You just kind of like group all the expenses together. So income tax expense can be in that group or it can be separate. That's just, I just like to say things that are, I don't know, accounting stuff. All right, purchase discounts. What about purchase discounts? So I got a discount on my purchase of some inventory. That's what a purchase discount is. I got a 5% discount. Yeah.
And cost of goods sold.
Right. Yep. So anything involved with buying your inventory ends up going through cost of goods sold. And when you buy inventory, you want to include all of the costs to get the inventory ready for sale in the value of the inventory. All right. Sales discounts. How about sales discounts? Yeah.
Would that be a selling expense?
Well, right. So that would be, so I think the answer here is that it's part of net sales. So there's a couple ways of handling sales discounts. One of them is to report net sales at the very top. If you ever see net sales compared to just sales, net sales is net of discounts and allowances. So there's a couple things that's net of: returns, allowances, and discounts. But you can handle discounts in two different ways, and we'll talk about this when we get further on in the class. But just so you, just for like I guess this problem, we'll just say it's part of net sales. But you can do it in selling expenses too. Is it alternative way of trying to and then officers' salaries. I would so basically the CEO's salary. Where would that show up?
Admin.
Yeah, selling general administrative expenses. Okay, that's an administrative expense. And then freight out. So I'm selling something. I have to ship it out. What would that be? I have to pay for the shipping to my customer.
Selling expense.
Selling expense. That's G&A. And then interest income is the last one. You guys can read after you get this. Perfectly timed class. 1 minute left. This one's easy, right?
Other
Yeah.
revenue?
Other revenue. Yep. Other revenue. So yeah, some of these are new items. So I didn't expect you guys to know that, but you have this now. So